If you're thinking of buying a house in 2025, stop right there. Because Warren Buffett, yes, the billionaire investor who rarely makes public warnings, is saying something that's shocking millions. Buying a home right now might be one of the worst financial decisions you can make. Sounds crazy, right? We've been told for decades that home ownership is the ultimate dream. But what if that dream is actually slowing you down? In this video, you're about to discover the real reason why Buffett is flipping his stance on real estate, and why smart investors are quietly pulling out of the housing market. We're going deep into the numbers, the strategy, and the why behind the shift. You'll learn why owning property today could block your path to financial freedom, and how to position yourself where the real money is flowing. So if you're serious about building wealth, protecting your time, and creating passive income that doesn't chain you to a broken water heater or an overpriced mortgage, stay with me. What you're about to learn may completely change how you invest moving forward. Warren Buffett doesn't change his mind often, but when he does, people listen. The man who once praised single-family homes as solid investments is now pulling back. At his latest shareholder meeting, he highlighted how real estate has become more of a burden than a benefit. Too much effort, too little return. And when Buffett shifts gears, you can bet there's a deeper strategy behind it. Real estate might seem like a good way to make money, but it's rarely passive. From inspections to tenant complaints, there's always a new fire to put out. For those chasing true financial freedom or building an online business, the time sink can be brutal. You're not just investing money, you're investing your weekends, your sanity, and sometimes your savings. Buffett's new stance isn't about fear, it's about efficiency. He emphasized that, unlike the stock market, real estate comes with invisible strings attached. You're responsible for maintenance, tax hikes, even market dips that you can't control. Meanwhile, index funds like VOO or VTI let you ride long-term growth with minimal effort. You click, you invest, you walk away. That's the kind of low-stress strategy Buffett is favoring more in this stage of his life. Think about it. This is a man who understands the grind behind wealth creation. He's not anti-property, he's just pro-smart allocation. With talks of an economic recession on the rise, locking up cash in slow-moving assets like houses might not be the smartest play, especially if your goal is to build passive income streams that grow while you sleep. And who doesn't want to sleep well? Buffett's shift isn't about abandoning real estate altogether. It's about optimizing your energy. And this opens a door to the next big question. If real estate doesn't give the best return on your effort, what does? When you stack real estate next to the stock market, the numbers don't lie, they scream. Historically, real estate has offered about a 4.3% annual return. Not bad, right? But compare that to the 9.8% you'd get from the S&P 500 with dividends reinvested. That's more than double, and you didn't have to fix a leaky faucet to get it. What makes stocks even more appealing is the mental freedom. You're not tied to a physical asset, no phone calls at midnight, no dealing with property taxes or tenants skipping rent. You just check your portfolio, maybe rebalance it twice a year, and let compound interest do the heavy lifting. That's what makes it a smarter investment strategy for most people today. Let's say you're trying to build passive income. Real estate might help, but it's slower and riskier if you don't know the game. Stocks, on the other hand, are liquid, diversified, and scalable. You can start with $100 and grow from there. Try buying a house with that. Even Buffett, who once held physical assets like real estate as part of his empire, now focuses more on scalable assets like stocks and businesses. Why? Because that's where financial freedom lives. Real estate might offer security, but stocks offer acceleration, and in a volatile economy, speed matters. Still, many people cling to property because it's tangible. But in today's digital economy, tangibility is no longer king. Cash flow and growth potential are. And when you realize that, you'll start questioning whether that second rental property is really the best way to make money. Buying a home sounds glamorous until you're knee-deep in drywall dust because your tenant forgot to mention a leak for 2 months. Real estate is work, hidden work. Behind every rent check is a pile of time-consuming tasks: vetting tenants, handling repairs, staying compliant with local laws, managing the property yourself, or paying someone else to do it. This is where the stock market wins by a landslide. You're not chasing plumbers or scheduling inspections. You're clicking a button and reallocating funds. It's the kind of freedom people chasing online business and financial freedom dream about. And ironically, it's the one asset class people overlook because it feels less real. Want to build wealth efficiently? Focus on assets that don't eat up your day. That could mean dividend stocks like Johnson & Johnson, or ETFs like VOO that grow steadily over time. These vehicles don't call you at 9 p.m. They just grow in the background while you live your life or build your side hustle. Even if you're a landlord with systems in place, there's still emotional labor involved. One missed payment can trigger months of financial strain. Compare that to stocks, where one dip might sting but isn't personal. That emotional gap makes a big difference in long-term wealth-building stamina. And as you weigh out where to put your money and energy, ask yourself this: do you want to be a landlord or an investor? People love to say real estate always goes up. Well, not exactly. The housing market has only seen a few major crashes in the past century, 1929, 2008, and a few regional dips in between. But here's the kicker: real estate rarely becomes truly undervalued. That means you almost never get a steal. Stocks, on the other hand, crash hard and fast. But that volatility creates real opportunities. Buying during a dip, like in March 2020 or after the dot-com bubble, can supercharge your portfolio. Warren Buffett built his fortune by being greedy when others were fearful. You can't do that as easily with a house. Real estate tends to crawl during recessions, while stocks slingshot back once the panic fades. So if you're hunting for ROI, stocks give you more entry points. Real estate gives you stability, but rarely those moments where you can 10x your money fast. And in a game of financial freedom, timing matters. Let's be honest, unless you're a flipper or developer, you're playing the long game with real estate. That's fine, but don't confuse that with high growth. Passive income grows faster in markets where valuation swings create openings, and that's a space stocks dominate. Which leads to a curious thought. If you're investing to grow, not just to feel safe, shouldn't you be in a market that rewards bold moves? Selling a house can feel like a part-time job. Listing, staging, paperwork, negotiations, waiting. You can't just cash out overnight. Real estate is emotional and slow, and every transaction comes with friction. Meanwhile, stocks sold in seconds. No emotions, no back and forth, just click and move on. Liquidity matters more than people realize. Let's say a sudden emergency hits, or a golden opportunity appears. If your wealth is locked in a house, you're stuck. But if it's in a brokerage account, you're free to act instantly. That's the kind of agility that builds empires. The simplicity of stock transactions lowers the barrier to entry. New investors can start small, learn quickly, and iterate fast. Platforms like Fidelity or Charles Schwab offer fractional shares, automated investing, and built-in diversification. That's a dream for anyone running an online business or stacking passive income. Contrast that with real estate, where mistakes are costly. One bad deal can tie up your capital for years. There's little room for experimentation, especially in markets on the edge of a housing market crash. Real estate is high commitment. Stocks let you learn while earning. So when people talk about freedom, they often mean financial. But let's not forget time freedom. The ability to pivot quickly may just be your greatest asset of all. Let's talk numbers. If you'd put $50,000 into the S&P 500 in 1995 and reinvested dividends, you'd be sitting on over $940,000 today. That's nearly $1 million without lifting a hammer. If that same $50K went into a $250K property, your returns would land closer to $844,000, and that's before taxes, repairs, and headaches. Those aren't just numbers, they're proof of how effort stacks against reward. Real estate looks great on paper, but once you add in maintenance, property management fees, and vacancy periods, the returns shrink fast. Stocks just win in terms of ROI per hour invested. Even if you compare good real estate with average stocks, the market still edges out ahead. And in a world where time is your most valuable currency, why wouldn't you bet on the thing that compounds the fastest? Especially when you've got ETFs like SCHD or dividend giants like Coca-Cola working 24/7 for you. Buffett himself has said that over time, the stock market is a device for transferring money from the impatient to the patient. Real estate? It often rewards those with deep pockets and strong nerves. But you don't need either to win with stocks. You just need consistency. And if one asset class gives you more upside with less friction, maybe it's time to shift how you define smart investing. Now, don't get it twisted. Real estate isn't dead. If you're buying a home to live in long term, or you've got a rental in a landlord-friendly city like Dallas or Tampa, it can absolutely work, especially if you're playing the long game and you're ready to handle the curveballs. Housing offers more than ROI. It gives you roots, stability, and autonomy. Owning your own place means you don't answer to a landlord. You can customize your space, build equity, and feel more secure. It also offers tax advantages like mortgage interest deductions. For families, retirees, or people planning to settle for decades, real estate still holds emotional and financial value. There's also the niche of short-term rentals. Platforms like Airbnb can turn a property into a strong cash-flowing asset if you treat it like a business. That means mastering hospitality, pricing, and regulations. Not easy, but potentially lucrative for the right personality and location. And for some investors, real estate complements their portfolio by adding stability. It's less volatile than stocks and can act as a hedge during market downturns. But again, it's only smart if you go in with a strategy. Blindly buying because real estate is always safe is a fast track to disappointment. Which brings us to the deeper idea that's rarely talked about. How does your investment reflect your lifestyle goals? No smart investor bets it all on one horse. Warren Buffett himself holds both real estate and stocks. He just weights them differently. Diversification is less about owning everything and more about aligning each asset with its strength. Stocks for ROI, real estate for stability and utility. That's how you build lasting wealth. Think of your portfolio like a team. Stocks are your high scorers, fast, aggressive, growth-driven. Real estate is your defense, steady, grounded, protective. Together, they balance out the ride. You wouldn't build an online business with one client, right? Your investments need the same layered support. The goal isn't just to make money, it's to keep it, grow it, and sleep well at night. In times of economic recession, that balance becomes even more critical. Having a mix of assets smooths out volatility and gives you options when the unexpected hits. So don't fall for the trap of either or. It's not real estate versus stocks, it's real estate with stocks, calibrated to your effort level, goals, and risk tolerance. And once you find that sweet spot, you'll start building a financial freedom plan that actually fits your life. Now that you know the truth, what are you going to do with it? Are you still going to chase that forever home dream that drains your savings and locks up your time? Or are you ready to play the game the smart way, like Buffett does? Because here's the deal, wealth doesn't come from working harder. It comes from thinking better, from making bold decisions while everyone else follows the old broken blueprint. You've just unlocked insights that 99% of people will never hear, and even fewer will apply. But if you take action now, if you start aligning your energy with smarter assets, you won't just survive the next financial wave, you'll ride it. And that's how you build true financial freedom, on your terms, not the bank's. So, what's your next move? Let me know in the comments. I read every single one. And if you're ready to stop guessing and start growing, hit that subscribe button and turn on notifications. We're building a community of smart, strategic investors right here, and you belong in it.